Today's guest is Greg DiNardo, CPA, co-founder of SegTax's, and a Richmond-based platform using AI, 3D scanning, LiDAR, and expert human review to deliver engineered cost segregation studies faster and at lower cost. Greg launched SegTax's publicly in 2025 with co-founder Joe Akinfora to modernize how investors unlock depreciation and bonus depreciation opportunities. Greg, I'm excited to talk to you on the podcast today to learn more about this. This is something I definitely need to learn more about, but it looks like a really cool product that you are unlocking for investors. Welcome to the podcast.
Thank you for having me. This is awesome.
Yeah, I look forward to getting into this. So I want to know, I kind of want to get started. This is mostly about cost segregation, a little bit about taxes at a high level, all about how it relates to real estate investing. What is your background? How did you grow up in Richmond? Tell me a little bit about your background.
Yeah, I come from a kind of untraditional background. So I grew up in Salisbury, Maryland on the Eastern Shore, very kind of secluded area of the world. Grew up in a bit of a bubble down there, but it was a very unique upbringing. Kind of had a great group of friends down there, but kind of quickly realized that there's a much larger world outside of just the Eastern Shore. And I ended up going to boarding school up in Alexandria, Virginia, which is where I developed some relationships down here in Richmond.
You went to boarding school. What college did you go to?
So I ended up, I went to Episcopal, and then I went to Loyola in Maryland, played soccer there. And then, so I studied accounting in college, obviously. And I wanted to do something that was essentially kind of had an automatic job after college as kind of a, I guess like a linear thinker. And accounting was one of the fields that I felt, could have a solid career, didn't have to do more schooling, and joined what was the fifth biggest CPA firm at the time, called RSM. Did a couple years and just honestly didn't like it. It was I didn't love the billable hour component of it. Ultimately felt like kind of a cog in the wheel almost. Yeah. And so I just wanted to do something more exciting, and software at the time was kind of blowing up. And so I've decided I wanted to pivot my career into that field. Spent about a decade in the software world. So I actually started my own company with a friend from college, went through all the highs and lows of a startup, and ended up selling it to a company up in New York. So I stayed with that company for about 5 years as a product manager, working on new product initiatives mainly. And then throughout that time, I really had the itch to start my own thing again, kind of was able to see what like a big software company deals with. And but I really wanted to use like my unique experiences to, start my own company, and thought through many ideas over the years. And finally, actually, when I had my first son in May of last year, really thought through like what's next, and decided like the best thing I can do is bring my experience as a CPA and match with my experience in software. Mm-hmm. So that's kind of like where SegTax started.
So you were in college. You decided in college you wanted to do something accounting related to accounting?
So I wanted to major in something where I knew I kind of...
Just like there was a job waiting.
There was a job waiting, exactly, yeah.
Was there any influence, like did someone tell you, hey, you need to do accounting? Like this is where there's always going to be a job waiting for you? Or is that just the writing on the wall that you saw?
Yeah, I think, my father was a physician, and they, I think my parents wanted me to do something where, it was a professional type job. Right. And I didn't want to do something like, I was first of all horrible at science, so that was not in the cards for me. And then I didn't want to do like law because I didn't want to do 4 more years of school. So that's kind of like the next option. Right. I felt like, yeah.
Then you went into the accounting world, and it just wasn't for you, like billing your hours and stuff like that. And then you went into to develop software. Where did that idea come from?
That's a great question. I think, it's funny enough. Like at the time, like Shark Tank was a big thing. So I was like watching that and the entrepreneurial stuff. And then, I think just kind of had a fascination with these companies that were being built by people in their 20s that were having these pretty insane growth curves, and I just like the idea. Seeing my father growing up, he was a physician in a small town, so he was like kind of the community doctor. Like we'd go out to dinner, and a million people would come up to us and say hello, which was awesome. But I also saw how hard he worked, and he's literally trading his time for money, essentially.
Yep.
And same is true when I started my career in accounting. Was you're trading your time for money. So software is what I saw as kind of the play where you could really scale. I think there's a couple of opportunities where you can do that. One is real estate, where you're earning wealth over time, not trading. It's like a lot of times it's passive.
Right.
A lot of times it's not. But so that, investing in the stock market, and then building software companies, and building companies in general, where you're able to leverage more than just yourself, I guess.
Right. Was your software accounting related? Was that company accounting?
No,
or did you step
I actually
away from accounting?
moved really far away from accounting.
Interesting.
Like I kind of had a bad taste in my mouth around it, and I wanted to kind of move as far away from it as possible.
Really?
So it started as like it was kind of the time of like when Snapchat and all these things were popping up, and I was like, it was like 2015. So the first one was like a polling application where you could ask people. It was actually very sports related. So even like a bunch of athletes came on and were like asking like, what shoes should I wear for tonight's game, stuff like that.
Awesome.
So some of our investors were like NBA players actually.
Nice.
Which was pretty cool. But then we quickly realized to like grow a company, like there's not a great revenue model. So actually I moved really far away from my accounting background. So then we pivoted more into like market research space, like B2B market research. So it was more like pull and like quiz based stuff. But like, if you needed to do some research on, an example was a cable company that was going into a new market, and they needed to like find some details about that market, they could leverage us, and then we could find their target demographic. And then we ended up selling to a MarTech company, so like a marketing technology company. They wanted to integrate like our polling and market research opportunities into their platform.
And you stayed with that company for a few years through that transition? Yeah.
And they ended up just kind of over time actually essentially winding down our product and then putting me and my co-founder on a new product, which was super interesting. Product that actually did really well, called Markup. But it was for like, if you're like building a website, for instance, it allowed you to essentially enter your website and it would add like a commenting and collaboration layer on top. So it's like change that text. You don't have to like jump on a Zoom call. You can just like click it and add the comment on top. So that grew pretty into the millions in ARR, that product alone. And so that was a cool experience. But I also got to see kind of the bigger company side, which is nice. But then there's a lot of corporate politics and all that involved, and I was kind of over that.
Yeah. That's interesting. The website software, my website provider, editor, basically like who's hosting the website, you have to go through them to make any edits, and you would always have to jump on a call. And then like one day they just said, here's a link. Click the link, and I could click on anything and leave comics. I don't know. I need to go back and look, but it was like, but it literally like I could say change this icon, do this, change this color, change this font, like put this over here, do that. I could leave it all just on the website.
I bet it was markup.
And then like minutes later, maybe an hour later, they'd say done, check. And I'm just like, holy, that was so efficient. It was the most efficient. Like it literally stands out in my head because whenever I make a web edit, I'm almost excited to do it.
That's awesome.
Because I don't have to go through this, hey, just under this paragraph, right before this, you'll see this white space, and then about 3 inches. Well, I don't know, exactly. It's just like, it's cool. You can like,
exactly.
So that's awesome. That's cool.
Yep.
That sounds like a real valuable experience to have. I mean, both of those, the experience, whether you liked it or not, in the accounting firm, and then going to start your own thing, and then learning like how difficult that is, how tough it is, and the challenges, where's the money come from, and all these different things. Having a partner in a company, which could or could not be challenging, and then exiting and selling, and then going to work for a larger corporation. So that's some pretty significant experience to have. And then you ended up now starting partnering and starting SegTax. What was the lead? You kind of alluded to it earlier where you said like, I kind of brought these two interests together. What kind of more in depth, like what went through your head? You needed to, that entrepreneurship kind of feeling again, like to scratch that itch and then bring some things you were very familiar with through that software?
Yeah. So I think when I was working at the larger software company, I really felt like I was just, doing a job. I didn't have that like kind of the ownership and the essentially like the excitement that comes with when you own your own business. It's a lot of stress, obviously, but there's nothing that really compares, I don't think. So I knew I wanted to get that kind of feeling back where one, you truly own your destiny. And so that was number one driver for me. And then two, I think, so in that like MarTech space, super, super crowded. There's no real like barrier. There's no like real moats. It's just like a tough space to be in. So I knew I wanted to go into a space where I could have some kind of differentiated knowledge where just like, an 18-year-old, it's like vibe coding, which is a new thing these days, would have a really difficult time like building a really solid product in the space without that kind of subject matter expertise.
Yeah.
And then I also, so that drove me to accounting. And then within accounting, the thing I didn't like about tax in the past was just like general compliance work, where it's like you get a client's W-2 and 1099, and you're essentially just moving that through another software, and then you're sending them a bill, and it's hard to add a lot of value like that. And the other thing I hated was like calling a client and be like, hey, you owe 20 grand. So I wanted to find a space where, I could provide value to a client where maybe they're not getting that from their traditional CPA. And then also be able to have kind of the opposite thing where it's like, we saved you 20 grand versus you. And this is not like a new tax strategy, obviously, but a big thing I wanted to do is say, because there was kind of always this notion that like, unless you have a property that's over $1 million, cost seg doesn't make sense. A big part of that is because the fee on the cost seg is generally pretty hefty. Right. So we wanted to essentially democratize access to tax strategies that at one point were only available to the wealthy, like the very, very wealthy.
Right. I mean, that is what I'm familiar with cost seg, and where a lot of the investors that suggest it, where people are like, man, I'm going to pay so much on taxes. A lot of the advice is you should do a cost segregation. Yep. And then there were sort of what always piggybacks that comment is it's really expensive, but it should be worth it, And so you're trying to bring this to make this cost more feasible for maybe the smaller investors that don't have millions of dollars or might have smaller assets, but they still want to save some money on taxes.
Yeah. Yep. And then even like, whether it's the smaller, the people that are syndicating and are a little tighter, and even upmarket people, are still looking to save some money. So, so we're looking to serve a broad base, but we've started to find a niche in that kind of smaller, like long tail of the market.
What did you have to do a lot of research going into this, or did you already have a pretty good understanding of cost segregation? What did that look like when you were like, I want to niche down into this? What did your process look like to get ready for that?
Great question. So I should say that like when I decided I wanted to get back into the tax space, I didn't like narrow down on cost seg right away. I did a bunch of interviews I knew I wanted to go into something like I mentioned that was like value add. So the two main areas that you can do that in tax are with business owners or real estate investors. So I did a bunch of interviews with like just people in my network in those spaces. And then also did a lot of interviews with like former colleagues of mine in the tax space or just CPAs I knew. And amongst the real estate investors, like one thing that always came up was cost seg. And there was always often a complaint about the costs associated with it. And then on the other side, I was able to interview a couple people that did cost seg at a very high level, maybe have been doing it for 30, 40 years, and have them just walk me through kind of their process. And I asked, like, when was the last time this changed? And they told me, when Excel launched in like 1992 or whatever it was. Right. So I found that super interesting. But it is a entirely new skill set than what I had learned, in my early days of accounting. Essentially we were able to find a couple advisors that have been doing this for, as I mentioned, 20, 40 years. Mm-hmm. And had a couple first engagements. We just did 100% manually and then walked with them through that. And that included my co-founder, Joe, who was previously a software engineer at Meta, who's like awesome. Manually in the weeds, kind of he was even going to site visits and like really getting his hands dirty. And then his brain is just thinking like, how do we, where are there opportunities to automate and like what can't be automated, but that we can like just improve the workflow around. So I'd say probably like our first cost segregation study we did as part of SegTax was this time last year. So last November. So from like November to March, we did everything manual. Yeah. Just traditional. And then in March we started building out the product, and but I think that was key. We had to really know the ins and outs, and especially by different property type and all that. Yep. Before we even wrote a single line of code.
That's a great way to do it. I also like that you look for something that wasn't easily replicated by vibe coding or anything like that, because I see a lot of these other businesses popping up, and I'm like, someone's going to be able to write that like pretty quickly. But I understand what you mean about like wanting to know everything about cost segregation, hands-on, manual, before you try to automate anything or bring this new technology into it. I dropped out of college, and I told myself I wanted to own American Honda one day. And that was my goal. And it was in American Honda, for anyone listening, was like the motorcycle division. Like it was race bikes, like motorcycles. And so I dropped out of college and said, I'm going to own American Honda, but I need to know how the motorcycles work first. So I moved to Orlando and went to a trade school and worked on motorcycles for years. And my goal was to learn every nut and bolt inside the motor. Like, what does everything do from the crank out, from the main journals around the crank, like everything in the entire motorcycle. What does it do? How does it work? Build them, hands-on, repair them. And then I would be able to move forward in sort of the Honda corporate. And it actually, it worked pretty well. I mean, I was managing in a Honda dealership, and then I was talking to regional managers that look over like 5 and 6 states of Honda dealerships at a time. And they were all like 20, 30 years older than me at the time, but they were like recruiting me into their world at that point. Then I got in a terrible motorcycle accident, and everything changed. My whole outlook on life changed. My whole like purpose and intent changed after that. But I wanted to learn every nut and bolt. And then when it came to property management, I didn't really have an option to like just do this and have employees and everything. But the first 2 or 3 years, it was me doing every single thing in the company. But that really is so beneficial, because 100%. Then I was like, the property managers have questions, and I have a great, at least like foundation of how to do it. And then it's also allowed me to develop a network of people who have done it for 20 years, 15 years, 10 years, 30 years, and get advice from them on that experience that I was lacking. And then now we've been able to hire a lot of people with way more experience and bring them on the team. But I think that's the right way to do it, because it sounds like with the partner you have and with your tax experience, and then you have a partner that has all the software experience, it seems like a really strong partnership. And then if you have the you've got your hands dirty in it, and then you have the relationships that can give you that advice, that have been doing it for 15, 20, 30 years, that's a great formula to get this thing off the ground. Yeah, exactly. I think there's no replacing that you need to have that like expertise. Like you can't just buy you can, I guess, buy that experience, but like might be out of the budget. Yeah, exactly. And like you can't just learn that overnight. Right. Like, for sure. So and getting your hands dirty is also so key. Yeah. In those early months when you were doing everything manually, were you like, oh, I understand why this is so expensive now? I think it was more so. That's a good question. I think I understood, why it was so expensive, but also like a lot of it is, so a big component is getting really good data on the front end, so from the property. But then from that, it's just like pushing a lot of the same numbers around. So there's a lot of efficiencies to be had. Like it was like kind of eye-opening, like, wow, like I would rip my hair out if I was doing this every day the way you guys are doing it. And that's how I used to feel in accounting, was just like, God, right. And at the end of the day, the clients are, paying for that. That time of inefficiency, essentially. That's a great way to put it. Yeah, if you clean it up, then they don't have to pay for that inefficiency, and everyone's happier. Right. So let's talk about cost segregation. We'll keep this at a relatively high level, but I do want to get into like what it is and what it means for the investor and things like that. Sure. At a high level, let's say 60 seconds or less, even though I'm not timing it. What is, because I have a bunch of other follow-up questions on this to go a little bit deeper, but what is cost segregation, and why should investors care about it? Yeah, essentially cost segregation allows you to, actually I'll step back and say that
typically when you buy a property, the IRS looks at that property as one asset that depreciates over 27 and a half years or 39 years, depending on if it's commercial or residential. And essentially within that building, there's hundreds of different assets, and a cost segregation essentially allows you to break the property up into those assets. So everything from the cabinetry to the flooring to the parking lot to the walkway all have different depreciable lives. So the cost seg is essentially the process of breaking that up into the typical buckets are 5 years, which is a lot of the interior stuff, 7 years, which is like office furniture, and then 15 years, which is a lot of exterior land improvements. And generally you can accelerate like 20 to 30% of the property into those buckets, and we'll talk about it, I think, later, but there's also something called bonus depreciation, which allows you to further accelerate that.
And the idea is like that, again, at a very basic level, when you talk about depreciation, that is basically amounts of money that you can put against earned income, right?
So yes, earned income. So there's kind of two buckets. So if you're a real estate professional, then yes, it can be against all your income. If you're not a real estate professional, so somebody like myself, that kind of stays in a passive income bucket. So it can offset essentially all your real estate activity.
Right.
Yeah.
So passive income as well.
Correct. Yeah. Exactly. Yep.
And so it would be beneficial if you make a lot. Essentially, if you have high income, and then you need to pay. You want to pay less taxes.
Yep.
So you do the cost segregation to kind of accelerate that depreciation, so that you're not taxed as much that year.
Correct. So it's totally a time value of money play. Like you're just moving up depreciation essentially from 40 years, which is half a lifetime, to a lot of it into year one. And so you're able to offset if you're a real estate like a real estate professional, you can offset up to all your income for the year, depending on the size of the property and how much you have. If you're somebody like me, I think you actually have to think about it a little more strategically. And I can go into some of those examples, but yeah.
Awesome. Well, when is it worth doing? Like, let's start with the asset type first.
Sure.
Like, if I have a $300,000 house or a multi-million-dollar apartment building, like let's look at it from that way. When is it worth doing? When may it not be worth doing?
Yeah. So I think residential is a great asset class for cost seg. I think, generally, again, it'll get in that 20 to 30% range. And in terms of if you should do it or not, I think our goal is SegTax's to make it so it doesn't matter the purchase price. It's going to be the return on your investment for the fee to the cost seg is going to make sense. So then it comes down to essentially, we can start with real estate professionals. If you're planning on holding that for more than 3 years, a lot of times it'll make sense to do it. I'd say if you're planning on selling it next year, it doesn't make sense to do the cost seg. Just save the money. But yeah, if you're planning on buying and holding, I think as a real estate professional, it's most times a no-brainer. For someone, again, in like my shoes, who has a typical W-2 job, and doesn't qualify for this designation that is a real estate professional in the IRS, then you have to be a little more selective because, let's say a client has a $200,000 job, it's traditional W-2, then they buy a rental property for $500,000, and they do a cost seg. Maybe they can have a $100,000 first year accelerated depreciation thanks to this 100% bonus depreciation. However, a lot of that's going to get kind of locked up because you can only offset that passive income that you have there. So you can't offset that $200,000. So with those folks, it's more about timing. So for instance, let's say you have 4 properties and you have this, you're not a real estate professional, and you sell one of them in 2026. You could technically, and let's say you have a $100,000 gain, you could technically use a cost seg from one of your other properties and offset that gain. So even though that is it's called a 1231 gain, it's different than selling a Apple stock, for instance. It's a different type of capital gain, and those can offset each other. So
interesting.
The the gains from a sale of a rental property can be offset by the losses of another property.
Yeah, that's interesting. I think I definitely had more knowledge early on in my investing career, I probably could have saved a lot of money, because there were certain times where I was moving very quickly in acquiring assets, and then I'd had some other assets and needed to sell those. But these other assets I'm going to hang on to in theory forever. You know, I'm just never going to sell them. But I had to sell other assets to like recapitalize. We pay so much on taxes. Had I done like a cost seg or something on a couple of the other assets, it may have really helped.
And then ideally,
What about like scope of improvements? Like if you have, does it make any difference if you have a large rehab? Like you buy a really distressed property, you're going to hold on to it forever. You put $100,000 into a $300,000 house to get it to $300,000 in value. Does that make any difference? Like, what is the timing of that cost seg? What would it look like in that scenario?
Yeah, great question. So essentially, in that scenario, you would do two separate cost segs. So, excuse me, you do one on the purchase. So, what was the example there? You bought it for 300.
Let's say you bought it without doing the math. Let's just say you bought it really distressed. So you bought it for $100,000, but you have to put $100 into it to make it worth $300.
Right. Okay. So you could do a cost seg on the purchase. So even though it's in a terrible, circumstances, there's still assets within it. So you can do that initial one. Your benefit on that's going to be lower. Like it might be, 10% or something versus 20 or 30. But then, you do $100,000, 50 of renovations. You can do a cost seg on that full renovation. That actually might be a little higher because essentially, if you're doing a ground up build, a lot of that, the cost is going into the structure. Like ideally you still have the structure of the building. So then it's going into your interior assets and your landscaping. So the CapEx could actually be like 35% because, a lot of it's like LVP and cabinetry and carpet and a new driveway and all that stuff can be cost segregated. So I think overall your benefit would probably end up around the same place, but it's a little more complicated process than just like new purchase, you rent it out day one. But yeah, so there's great benefit in that and there's another thing, essentially when you do that renovation, there's actually something called a partial asset disposition. So when you dispose of those assets that you pull out, you can actually like write off the remaining depreciable basis of those assets in the year they're disposed of. So that's super in the weeds, but it's like a really valuable tax strategy.
What would be an example of that?
So let's say you bought a single family home, and it was like a gut job, or even if it wasn't a total gut job, but like, you replaced the cabinets, you replaced the driveway, you replaced just a lot of the interior stuff. Like essentially if you do an initial cost, like each of those has a value assigned to them, and then when you rip it out, let's say it was 30% depreciated by the time you did the renovation, then the remaining basis can be essentially deducted in the year that you pull it out. And actually when you do the partial asset disposition, it's actually avoids recapture down the road because it doesn't exist anymore. So it's essentially like it's a disposition. So another big kind of misunderstood thing is that that you have to do like the cost seg in the year purchase. But actually I'd say that like 40% of the studies we do nowadays are properties that were acquired in a prior year, and then they do a cost seg on it in the current tax year. So like example is they bought it in 2017 and kind of just did straight line depreciation up until 2024 or 2025, and then in 2025 they realized that they want to do a cost seg on it. Essentially there's a form that gets attached to your tax return called a change in accounting methods, which is that form 3115. So when we do a cost seg, we automatically prepare a version of that to be sent to your CPA.
Interesting.
But essentially that form is saying, up until now, you've been doing straight line depreciation. This is how much depreciation you've taken to date. So maybe that's 50K. If you did a cost seg on day one in 2017, you would have actually taken 200,000 up until now. So there's a $150,000 adjustment that's taken in the current tax year. So you don't have to like go back and amend
Right.
2017 tax return. So yeah, it's it actually allows you to also time the studies a bit. So maybe you didn't want to do a cost seg up until now, but you do have that big tax hit because you sold a property. It allows you to say, all right, I don't have to go buy a new property to get a deduction. I can actually look at my existing portfolio. We had a good example of that this year. I would say several, but one that sticks out is a client that actually invested in like an opportunity zone fund a couple years ago. And the fund never actually invested in the opportunity zone. And then this year, he's going to realize all the gains that were going into his initial investment. This was like 2 weeks before the tax deadline. So we, looked at his portfolio with him and his CPA, identified 2 properties that essentially would wipe out his tax burden for the year. So I think the timing stuff's really cool. Like in the future, we love to build some kind of like scenario analysis thing out where people could just essentially upload all their properties, share kind of what their tax year looks like, and like here's a couple options.
Right.
And that's kind of like, can just do that on their own at first, and maybe then they reach out to us after.
Right.
But I think, essentially we're starting at cost seg, but we'd like to get into some other things in the future.
That sounds awesome. And I think a lot of people who don't do cost seg is because they don't want to invest in it where they don't know what the outcome is going to be.
Right.
Because they don't understand it. Right. Yeah. And I would probably fall into that category to some extent where like I know it could save me a lot of money, but I have to invest this much to see how much it's going to save me. Whereas if I had some sort of like roadmap to understand what assets I should do in which year, like what and what that might look like based on the basis or anything else, that would be pretty cool. I think that would be really helpful.
Yep.
Let's talk about, you've mentioned it a couple times, let's talk about bonus depreciation. So we're back to 100% bonus depreciation. I think, is it after January 19, 2025?
Yep. Mm-hmm.
Yeah. Talk to us about that a little bit. What is 100% bonus depreciation mean, and why does it matter for investors?
Yeah. So in the context of cost segregation and real estate, essentially anything that is accelerated from like real property into these, which real property is like the building, your real estate, into these other buckets we talked about. So the 5-year property, 7-year property, or 15-year property, they all qualify for what is bonus depreciation. And that has been something that's fluctuated over the years. So going into last year, so 2023 it was 80%, 2024 was 60%, and the new administration made it 100%, and it made it 100% so that it was actually permanent going forward. Mm-hmm. That's not to say that it won't change again in the future, but I think it'll be a lot harder for it to change now that it's like it is permanent and not a temporary increase to 100%.
Is there any situation where, any like planning scenario where you wouldn't want to take the 100% bonus?
I'm sure. Yeah. I mean, and I don't know if I'm sorry if I didn't mention, but yeah, so because of 100%, those things can be taken all in year one, essentially. I think, for non-real estate, I guess, yeah, so the scenario would be if you accelerate so much that you essentially, you're not able, that you like have more loss than you have income in the tax year. It's either something you like opt into or opt out of. So I think the good thing about that scenario is it just carries forward into the next year. Mm-hmm. So it's not like you lose any losses that you accelerate. So, that's benefit for next year. So it kind of stinks that you don't get the full benefit for the, study in this example that you just paid for, but it at least helps you with the next year as well.
You don't lose it.
Yeah, exactly.
It carries over, so you can carry over your losses year to year. And then do you have to take those losses the next year, or can they continue to carry? Yeah,
essentially, if you would essentially take them the next year if you have income to offset it. but they will continue to carry after that.
Interesting.
Yeah.
Give us some examples of when a cost seg really worked with SegTax, like one of your clients. And you don't have to, obviously, like no addresses or names or anything like that, but just an example of some cost segregation studies that use the asset type and what the numbers look like.
Yeah, I guess I can give two. So essentially our goal as when we started SegTax was to touch every asset class. So, doing big industrial, doing mobile home parks, which is a great asset for cost seg, by the way. Doing office, like we wanted to touch everything and just see kind of where we felt most comfortable and where we thought there was most room for kind of automation, and so we've kind of settled in on residential being a main area of focus, and so large multifamily is great because essentially, so let's talk about like a 300 unit property, so big property. Each of those units has, kitchen, and the kitchen is one of the main areas of focus for a cost seg. And also they're also generally very, very similar in nature. So essentially if there's like a 2-bed, 1-bath, a 1-bed, 1-bath, and a 3-bed, 1-bath, generally we only have to go into like one of each of those, and then we're able to kind of multiply it out by the number of each unit. So I think those are one of the more efficient in terms of like being able to get the most out of the study, I think. And yeah, I mean, those will go, anywhere from 27 to like 31%, the big multifamily, just because there's a ton of assets, and they also have a lot of land improvements, big parking lots, sidewalks, pools, like pickleball courts, all this kind of stuff. So I'd say that large multifamily has been that's kind of an area that we focused on in the beginning and is where we feel really comfortable. And then single family homes are awesome. I think, in terms of being able to automate a lot, like a lot of times there's great public data on that stuff, from photos on Zillow, which actually allows us a lot of times to save having to do a site visit, which saves the client. And so those, I think they're generally a little lower than the big multi. So maybe that's like 21 to 25%, just because, there's only one, or
right.
Maybe if it's a quad, there's 4 kitchens. But still, they're able to do really well. And then on the other scale, there's big industrial, and industrial is challenging. There's, a lot of different, each building's very, very different, whereas residential is very similar in the type of assets to make up the building. Like,
right.
Each one's going to have flooring, cabinetry, countertops, base molding for the most part. So yeah, that's where we felt really comfortable, is that residential side.
Do you have any examples of like some strange industrial buildings that you've like struggled with some of the assets inside of it?
Yeah, we had one in West Virginia recently, out by like the Ohio border, and they had just about like I just kind of imagined industrial buildings just being like, where they're storing and manufacturing things, but this one had a church, like an AAA facility in it. Like they had literally it was like a hodgepodge of different things in there, just super interesting. And then it was in West Virginia, so we sent one of our guys out there, and he's like, I mean, yeah, kind of get me out of this area. But nothing against West Virginia. But,
yeah,
it was in like kind of deep West Virginia. So,
that's awesome.
So, yeah,
you probably don't expect like your company to take you to places like that every now and then.
Exactly. And then, at some of these residential properties, you'll see some crazy stuff, whether it's just like the way that some of the, and I know you see this too, but just the way some tenants leave stuff, you never know what's going to be around the corner.
Right.
So, yeah.
Yeah, just in general, like even, we can go down that rabbit hole, but yeah, there's a lot of unique things. Especially like the residential side is how people live, so you can imagine how anyone lives, and whatever they're into, whatever, just we see it all.
Yeah, exactly.
And that's, we're like in people's houses, so you see everything that goes on, and everything that could go on in like a human life is what we're involved in. So yeah, we definitely see a lot, and if you're getting on site to these properties, I'm sure you're going to see a lot as
exactly.
well.
Yep.
What about audit? So obviously this is all like IRS friendly, but if the IRS is auditing a return and that investor or person has done a cost segregation study, what should the study have? Like, what would cause some red flags for the IRS when they're reviewing it?
Yeah, I'd say the number. So I think the number one thing is there's something called like a statistical sampling. Like, this is kind of in the weeds, but essentially saying that, like, there's on the low end of the market, there's some more like DIY solutions out there for cost seg, and basically it'll do like more average based, like a typical single family home gets X, Y, and Z for benefit, and not looking at each property as an individual asset. So I think that's the number one kind of main issue. And then a second one is just being super, super aggressive with positioning. Like, we've seen clients provide us previous studies where they got like 45% or something, like, and the IRS looks for like inconsistencies. Like, if they say, all right, we have all this data on multifamily properties, and typically they're between 25 and 30%, but yours says 50%. Like, what the hell? What do you have in there? Like, like golden, I don't know, like flooring or, so that's, I think that's the big one. Like, you don't want to be a massive outlier.
Right.
And then you just want to have really strong document. So essentially the form you get as part of a cost seg is a long PDF. That's the standard, and we provide that. But you want to, an IRS agent asks for the cost seg, because the cost seg doesn't actually go with your tax return. It's just like a work paper for your tax return. So they ask for it. You want to have just really strong documentation around, this is how the cost seg was done. This is a breakdown of like the assets within the property, and we'll show like kind of like there was 5,000 square feet of carpet, whatever, and then some kind of documentation of the actual property. So like photos. For us, on certain properties, we'll actually have like a 3D scan of the interior of a property. So yeah, I think having that level of detail is key. And yeah, I think as long as the firm is engaged to do the cost seg study is following the proper methods, like, there's nothing to be really scared of with the cost seg. It's just if people are trying to take shortcuts or just being really aggressive is where you can get into trouble. So yeah, but I mean, I think the good news is this is a tax deferral strategy. So it's not like a credit, for instance, which are way more heavily looked at. So it is moving like existing depreciation or expense just forward. You're not creating new expense, essentially.
Right. Do you work with short-term rentals at all, like Airbnbs or B&Bs or VRBOs or anything like that, and do cost seg studies for those?
Correct, yeah.
What are some benefits of those investors doing that on those assets? Or because, usually they're furnished, they have all kinds of assets inside of those. What's your advice or opinions or insight on doing cost seg on those properties?
Yeah. So, I mean, typically those are very similar to just like a long-term rental in terms of like our process. However, there is usually heavier furniture, as you mentioned, because they are furnished. I think the main differentiator there is that someone, to use myself as an example again, like someone like me who's not technically a real estate professional, there is something called like a short-term rental loophole, which is what it's called, which, because the average stay is under 30 days, you're able to essentially use that to offset some of your active income. And I think anyone that has owned a short-term rental appreciates the fact that it is truly an active trait. Like, you're dealing with calls on the weekend, maybe even more active than a lot of people's W-2 jobs. So,
probably.
Because there's no turning off. Like, you never know when you're going to get the call. So it's treated as active, and then you can use the losses to offset like non-real estate professional active income. So it's a great strategy for people looking to offset active income, with the caveat that like it's not passive. It is so someone that's like thinking of ways to get around paying taxes, like, I think it's really important to realize what you're getting into with short-term rentals. And like, yeah, essentially you can't just buy the short-term rental and then have someone else deal with everything. Like you have to actually be active in the day-to-day of that.
Help me understand the risk of recapture. So if you over depreciate and then sell, it's possible the IRS will want to recapture some of that depreciation, and then you'll pay higher taxes on that. What's your advice or what kind of feedback do you give investors when they talk to you about a risk of recapture?
Yeah. So recapture is just the price you pay with owning real estate. Like you get this amazing kind of like phantom benefit of depreciation, which isn't a real expense. However, it's not like this. It is an incredible tax strategy. However, it's not like the IRS knows that that no money was exchanged during that process, and like they want to recapture that. I mean, quite literally recapture that on the back end. So there's no silver bullet to avoid recapture, but there's strategies on the back end to help mitigate that. So I think it's important. We try to make sure that all our clients are aware that recapture is a thing in the future. However, if you have a strong portfolio of other properties, like there's ways, like we we're talking about other time, your cost segs to kind of like alleviate some of that. There's also things like 1031 exchange, but you're ultimately kicking the can down the road.
Right.
But time value of money, like super powerful. And yeah, so I think it's important thing to think about when you go into a cost seg or just think about depreciation in general. But there's no like you're gonna have recapture if you do a cost seg or not. Just like your recapture is gonna be higher probably if you do the cost seg. And that's one of the reasons like it definitely doesn't make sense to do a cost seg if you're gonna sell next year, because you're just gonna have recapture in that next year.
Right.
So yeah.
So you like holding it longer kind of reduces that a little bit, and then you mentioned 1031 exchange. So and you also mentioned kicking the can down the road, but you can essentially do 1031 exchanges and go into different properties and not have to worry about the recapture until whenever you stop doing that.
Right.
Yeah.
Or the more morbid way to think about it is when you pass away.
Yeah.
Your children or beneficiaries will get a step up in basis and essentially get the property at the fair market value today. So they don't have to deal with any of that recapture or anything.
Right.
So it's great. Unfortunately, stinks for the ones building it, but for your dependents, you're leaving them potentially a great asset.
Well, I think like if they're building it that way, obviously no one wants to pass away and leave their family behind. But if they're building it that way with their family in mind, they're happy to do so. They're glad that they had the chance to do that for their family. Correct. And that's a great plan for them.
Yep, exactly.
So let's talk about SegTax specifically. So I'm an investor. I have a portfolio of houses and apartment buildings, and I come to you and just want to learn more about cost segregation. I'm interested in that. How does it work once I engage with you? Like, what is the general process like?
Yeah. So there's a couple ways. So number one, there's a form on our website you can fill out to give us some info about your property. One thing we're spinning up now that developers are working on is basically collecting that address and then creating, essentially analyzing the public information about that property, and then creating a first draft of a proposal that'll show estimate of benefits. That'll then go to me or somebody on our team to do a final review and then send off to the client. But ideally, because of that, we're able to get a proposal back to you in 24 hours.
Awesome.
With estimate of benefit, fee, and essentially what's the ROI on the study for your first year benefit. And then from there, you'd be just dealing with somebody from our team that would collect the basic information. So if that's a purchase, that's going to be, so if it's a current year purchase, that's going to be your settlement statement, appraisal survey, and then depending on the property size, we might need to also facilitate a site visit. Mm-hmm. And that's also dependent on the quality of the information the client has, like photos and all that kind of stuff. It's a little different for new construction. We'll request a different set of information, but like the AIA docs and all that. but essentially collect that information. And then the goal is essentially once we get all that information to turn things around from a single family home, it could be 2 days to, something much larger could be 4 weeks. So it just depends on the size of the property and the complexity.
So roughly 24 hours from reaching out and providing the data that you need, you can provide an estimate as far as like fees are concerned, but also like a return, like what this might look like once we're done based on the information I provided, which is awesome. That means like I don't have to wait. Like I don't have to wait and meet someone on site and do all this and go through all this stuff just to see what might happen.
Yeah.
And I can get a fairly decent idea of what I could expect. And then if we engage, then it could, again, depending on how much information you need and how large an asset is and stuff like that, you could essentially have it done within a week or so.
Correct. Yep. For the smaller, like single family. Yep.
That's pretty cool. Talk to me a little bit about the LiDAR and 3D scans. What's that all about?
Yeah. So kind of referenced it earlier, but like the most critical part of a cost seg study is like good quality data in, because you can't have a high quality output without high quality input. So a couple different ways we go about it. And one of those is the LiDAR 3D scans. So generally this is for, we like large multifamily, we use this a lot. But essentially, with your phone, you can do a 3D scan of, essentially we do like one of each of the rooms for multifamily. And that'll have like very accurate measurements. So like almost millimeter precision on the linear feet of your cabinetry, the square footage of the room, the perimeter, like the base molding that we collect, and then like other assets, like it'll identify there's a refrigerator, there's dishwasher, all that stuff. So then we're able to basically pass that metadata through our system and then begin kind of the cost seg process of like pricing out the items and then generating a report in the back end. So
that's pretty awesome.
So yeah, it's a little like the collection piece is like requires effort, but because of that, we're able to automate a lot of the back end process essentially.
Right. How does AI play a role as it currently stands?
So I mean, AI is in the background of that, like extraction and identification of the assets. Mm-hmm. And then we're using AI and like OCR to pull out things from things like the appraisal, from the settlement statement, from even analyzing like the survey. And then for especially single family homes, we're analyzing a lot of photos. So identifying assets within those photos and extracting that data. So that's like the vision models
right.
of OpenAI. So I think we essentially the way we looked at it is we need to build a very strong workflow solution that a human could go through,
right.
and then layer on the AI on top to do pieces of that,
right.
and like break those pieces up into very, very small. Like there's a AI component that looks at just identifying the closing costs that need to get capitalized in a settlement statement. There's one that'll just look at the photos and like identify the assets within them, and then just breaking up each of those steps into really, really small chunks, rather than trying to say like, do this cost seg study, which is like a ticket to failure essentially.
Right.
And so I think it's kind of like identifying where the AI can help, have the AI explain kind of its reasoning as to how it got there, and then having a human like come in and review and kind of work with it, but like not 100% rely on the AI.
Right.
It's essentially a staff member, like.
Right.
And at times it's a very junior level. At other times it's very senior level. So it just depends on the task.
I guess it's sort of like no offense to any paralegals out there, but it's sort of like you're paralegal and then you're the attorney.
Right.
But so you have this paralegal that's delivering all this information and data and compiling it, and then an expert human looks at it and makes sure that it's all accurate and that it's presented how it should be.
Correct.
And then it's delivered to a CPA.
So it's the client or the CPA, depending on who engaged us. Yeah. So sometimes we'll work directly with the CPA on behalf of their clients. Other times we'll be working with clients and they'll send it to their CPA, but a lot of times they'll like rope us in on the back end with the CPA. I think another thing that it also can do is like, you look at one of these studies, another thing that we're working on now is like, so you look at one of these studies, like it's just like so much data, and like as an expert, you're reviewing before you sign off to like give a essentially say like everything looks good to go, but you're looking through like hundreds of data points, and like it's challenging. So another thing we're doing is like using the AI to say, all right, typically, as we mentioned earlier, like the benchmark for multifamily is X amount of flooring. Like this is way over. Like you need to look into this, and essentially, help identify even human errors.
So if there's outliers in the data that just don't, like the AI can get used to understanding what the normal ranges are, and then if there's outliers, it can kind of throw a flag.
Correct.
That it needs some.
And it's like this
some
needs
additional
human review, and even could say at first pass like,
right.
This is all like the total square footage for the carpet and LVP and whatever is more than the actual square footage of the building. Like something's
right,
so
right.
And like that stuff happens. Like human error happens, and yes, I think that's a huge opportunity. Like I remember when I was doing these things manually, I would look at it about 100 times before I sent it to a client, because I just was so cautious and didn't want to have a big error in there. So this helps tremendously with that. Yeah.
Do you get good feedback, positive feedback from the CPAs when you're working with them?
Yeah, 100%. I mean, I think the CPA's goal is like, well, I should caveat, like going into this, I was a little nervous that CPAs would be like, scared of technology and not, like essentially not trust it. So we've had a really strong stance of like, this isn't just technology, but technology allows us to reduce cost and time essentially. And I think when they're looking for providers, like one, it needs to be credible, and it needs to have like real professionals behind it. Two, they want to save their clients time and money. So I think being able to combine that has been great. So yes, CPAs have been super receptive, and yeah, so we've had a great experience so far with, like, at first when we went in the market, we were going directly to real estate professionals. Through those real estate professionals, we got introduced to a lot of CPAs, so it was kind of like a great organic way to get in with some of them. And then, yeah, I mean, I think we've just had CPAs in general reach out, which has been great too. So, yeah, it's I think the accounting profession is at an interesting point right now where like a high percentage of people are retiring. There's been studies that say like 75% of CPAs are retiring in the next 10 years. So there's like an interesting inflection point of like modern technology now, being able to assist with some of that.
Yep.
The alternative is like outsourcing to other countries, and like, so it's kind of like the perfect timing for that, from that sense, to like come in with a new alternative way to do things.
Yeah, a different perspective, which is healthy for industries.
Right.
It's good. So I'm glad to hear that.
Yeah. Yeah. Exactly. Yeah.
Who should call you? Like, what is your ideal client?
Honestly, I've really enjoyed working with like lower end of the market, people that are buying single family, maybe building up a portfolio of single family duplexes, quads, and I think part of the reason I've really enjoyed that is because up until recently there's been a barrier like of high quality information. So like I mentioned earlier, like I grew up on the Eastern Shore, and in places like that, like, or like West Virginia, like access to really high quality information is often not available. Like even for like healthcare, like a lot of times people would have to drive up to Hopkins or to DC to go to a good hospital when they need a really good specialist. I think the same is true as for tax. Like unless you're paying big dollars, like you're not going to get a lot of great tax advice.
Right.
I think AI actually has helped democratize a lot of that information. Like, you could go on and even if it's not perfect information, it can at least give you a sense of, here's a couple of options I have. I can talk to my CPA about it.
Right.
So I think this kind of lower end of the market hasn't always had access to this great information. Like, so we've been able to come into that space and I think provide a little bit of a benefit that they didn't have in the past. And so I think that lower end of the market's been the most exciting to me, honestly.
Right.
Yeah.
And they also, like, there's this, when I was first getting started, I didn't have access to a lot of this information. Now, I had a bunch of mentors, which were super helpful, but tax advice and legal advice, the mentors know not to give that, right?
Yeah.
Because they're not, CPAs
License.
are not exactly. So, so they would like point you in the right direction, But that's most of the time, like, you're not going to sit down and have an in-depth conversation about taxes with your mentor unless they happen to be a CPA.
Correct.
And so I had all these investors that were and business owners that were mentors, but they would kind of point me in the right direction, and then I would go to a CPA and ask these things. But the CPAs I either knew of or could afford, like, didn't really care to talk to me about this stuff.
Exactly.
Until I got to a certain period where I was like, okay, $600, $700 an hour, fine. Like, it's worth it. I need good advice. And now I have access to all kinds of information and things like that. And it saved me a lot of money.
Yeah.
But I didn't at first. And I think if I would have had that sooner, I probably would have been in a better position, at least during those years, as far as what taxes I paid or how much capital I had.
Yep.
So I think it's really important to kind of, again, people know that, like, cost segregation's out there, but they don't know they might not be willing to pay the thousands of dollars that it takes to do it, especially without knowing what the return is going to be, and it just be this black hole, right? But it sounds like you've set it up in a way to where it's more feasible for smaller investors, and they have a pretty good idea of what might come out of it before they have to go down this large rabbit hole.
Correct.
What should an investor bring on their first call with you? What information?
Yeah, I mean, really the only information we need is, like, purchase price, the like what year you purchased it in, and then the address, and generally that can give us enough information. If it was a study from a prior year property that they bought, a great piece of information that we always ask for is, like, just the depreciation report from your prior year tax return, because we kind of need to tie into the same exact numbers for the basis and the land value that the accountants use. So that's the other key one. But I think for that initial call, it's really just like address, purchase price, it's prior year, that depreciation schedule, and that's about it.
And you have a form online that they can fill out as well to, like, kind of get the ball rolling.
Correct. Yeah.
Sweet. What's next for SegTax? I mean, you've mentioned a few things that you guys are thinking about putting into place, but over the next few years, what should we look forward to?
Yeah, I think so. This next year, we're going to be, like, just laser focused on cost seg. We've got a small team, and we really want to build out this initial product very well. So I think through 2026 it'll be mostly cost seg, and then we touched on some components earlier in this segment about kind of like future, like what happens when I sell. So I think that's kind of the next thing we'll want to go into is, like, how do we look at the full life cycle versus just kind of the entry point. So we're kind of already doing purchase, then we're doing, like, renovation, which is kind of like mid, and then we like to focus on end. But we want to stay really focused on just, like, essentially real estate tax strategies. So super exciting area of the tax code, and it has some of the most benefit for strategy. So I think, tax code's huge, and, like, the way we kind of think of it is, like, you have, again, back to, like, the doctor reference, like, you have your generalist, and then they send you out to specialists. Like, we want to be the specialist in the real estate space. So yeah.
What's the website?
Seg.tax, SEG.tax.
Okay,
Yep.
Awesome. Seg.tax. Is that the best place for people to connect with you, or are you on social media or anything like that?
Yeah. So website's great to connect with me directly. LinkedIn's awesome, and then Twitter or X. I'm not super active, but I'm on there. So yeah.
Awesome.
Yeah.
Any final thoughts?
I don't think so. Just appreciate opportunity. It's the first time doing this, so I was a little nervous at first, but it's great being on here with you.
Yeah, I think it's awesome to have you. I'm fortunate that you're in Richmond. I know your product can go anywhere, but I think there's an awesome community of investors and brokers and real estate professionals in Richmond that could really benefit from meeting you, from knowing you, and from understanding your product. And so I appreciate you coming on. I know you don't typically do podcasts, and I would actually say neither do I until I started this thing. But yeah. But yeah, really appreciate what you're doing, and I like that you're making this more available and more. There's more. You're putting more information out there to all scales of investors and scopes of investors, investor sizes and different asset classes and net worth and stuff like that. So I think that's super important. Really appreciate what you're doing, and thank you for coming on the podcast.
Yeah, thank you so much.